Copper just hit an all-time high. One of the hottest defense stocks on the planet is quietly running out of gas, and there's a fintech name trading at a steep discount that most investors are simply too scared to touch. If you've got real money sitting in the market right now, at least one of those three things probably affects your portfolio today, and by the time this video ends, you're going to know exactly what to do about it. Ticker Hawk isn't here to hand you a vague watch list and wish you luck on your own research. We're taking a clear side on every single name in this video, buy or avoid, backed by the actual numbers, no hedging, no sitting on the fence. And if that's the kind of straight talk you're looking for every week, go ahead and subscribe now so you don't miss the next breakdown, because we've got 5 names today, and the order they come in might genuinely surprise you. Before we get into the individual stocks, you need a quick read on the broader economy, because none of these calls make sense floating in a vacuum. Existing home sales just came in at 4.06 million, down 1.7% from the prior month, and that's the weakest print since April, with the steepest monthly decline since May. Housing is still sick, plain and simple, and elevated interest rates are the reason why. That matters more than people realize, because a slow housing market ripples out into furniture sales, remodeling jobs, moving trucks, contractors, appliance stores, an entire chain of consumer spending that just isn't firing on all cylinders right now. On the inflation side, though, there's actually some good news worth sitting with for a second. Headline CPI eased to 3.4%, core CPI ticked down to 2.5%, both landing right in line with expectations, and both sitting at their lowest levels in a long stretch. Producer prices told a similar story, up just 4.7% year over year on the headline number, a sharp drop from the prior month's 5.5%, with core producer inflation cooling from 4.7% down to 4.2%. Wholesale inflation is easing, and that tends to show up on store shelves a few months down the road, which is a mildly bullish signal for anyone worried the Fed has to stay aggressive for much longer. Jobs data is more of a mixed bag right now, and this is one of those categories where you really need to look past the headline number to understand what's actually happening underneath it. Weekly jobless claims ticked up to 209,000, a touch hotter than the 202,000 economists expected, but continuing claims, which Ticker Hawk actually weighs more heavily than the weekly number, fell to 1.77 million from 1.88 million, and that tells you something important. People who do lose a job are still finding a new one fairly quickly. That distinction matters a lot more than most headlines give it credit for. The report that should really get your attention, though, is retail sales, which unexpectedly dropped 0.6% in July. That's the first monthly decline in 9 months, and the weakest reading since May of last year. Stack that on top of consumer sentiment sliding to a score of 51, well, under the 54.5 economists were expecting, with every single component of that survey sitting at its lowest point since June. And you've got real questions building about whether the American consumer is finally starting to run out of steam after years of resilience. Now, one soft data point doesn't mean you go rearranging your whole portfolio overnight, and Ticker Hawk isn't suggesting panic. But this is exactly the kind of thing that belongs on your watch list going forward. And next, week's manufacturing and business activity numbers deserve close attention, because that data tends to confirm or deny a slowdown story faster than almost any other report out there. With that backdrop in mind, let's get into the actual names. And we're starting with a buy that most people are sleeping on completely. SoFi Technologies, ticker SoFi. Here's the setup that makes this one interesting to Ticker Hawk. The stock is down more than 30% this year, and if you just glanced at that chart with zero other context, you'd assume something broke inside the company. It didn't. Membership numbers are sitting at an all-time high right now. Products per customer keep climbing quarter after quarter, and cross-selling keeps improving across the board. This company has quietly built itself into a genuine financial ecosystem, banking, investing, credit cards, personal loans, retirement accounts, and a growing technology platform underneath it all under one roof. And the more of those products a single customer signs up for, the harder it becomes for that customer to ever walk away, because switching costs go up every single time they add another service to their relationship with the company. Here's the number that really matters, though. Wall Street currently expects SoFi to grow earnings 53% this year and another 37% next year, and yet the stock trades at a forward price-to-earnings ratio of just 22. Divide that growth rate into the multiple, and you land on a PEG ratio well under 1, which in plain English means you're paying a discounted price for a growth rate most companies would kill to have on their books. Ticker Hawk's target on this one sits at $25 a share over the next 12 months. And here's the thing worth remembering: if the stock keeps drifting lower, while the actual underlying business keeps getting stronger every quarter, that gap between price and fundamentals doesn't close on its own forever. Eventually, the market has to catch up to reality, and when it does, it tends to move fast, often faster than most people are positioned for. That's name number one, but the next one might be the single cleanest macro trade sitting on this entire list, so stick around for it. Ticker, FCX, Freeport, McMoran. If you've heard anything at all about AI data centers, electric vehicles, or the power grid getting rebuilt for the next 2 decades, you already know the punchline coming. Nearly all of it runs through copper. And copper just hit an all-time high, up 16% this year alone and still climbing. Here's exactly why that matters for this specific company and not just for the commodity in general terms. When copper climbs from $6 to $6.50 a pound, that's 50 cents of pure upside per pound, and on roughly 4 billion pounds of annual production, that's an extra $2 billion flowing straight to Freeport's bottom line because the majority of their operating costs are locked in and simply don't move alongside the price of copper. New mines take years, sometimes over a decade, to get permitted and actually built, so global supply cannot show up fast, enough to meet steadily rising demand. That's a textbook setup for sustained pricing power, and it's the kind of dynamic that plays out over years, not months or quarters. And despite the stock already climbing nearly 20% since Tickerhawk first flagged this name a couple months back, shares still trade at a forward PE of just 16.2, well below the company's own 5-year average of 21 times earnings. Analysts rate it a strong buy with an average price target of $75, which is roughly 15% above where it trades today. This isn't just a mining stock sitting in a boring sector. It's a direct leveraged bet on the entire electrification and AI infrastructure build-out happening right now across the economy. And Tickerhawk thinks it's still cheap relative to everything coming over the next few years. Quick gut check for you. Drop a comment on which of these 2 names you'd actually put new money into first, SoFi or Freeport, because the third name on our buy list today is the one that's going to get some real pushback down in the comments section. Alibaba, ticker BABA. A lot of investors have written Chinese equities off completely at this point, and that's exactly why Tickerhawk is paying closer attention right now, because when an entire sector gets abandoned all at once, that's usually where the biggest mispricing hides in plain sight for anyone patient enough to look. Yes, China's real estate market and domestic consumer spending remain genuinely weak. No argument there whatsoever, and Tickerhawk isn't going to sugarcoat that. But manufacturing, exports, cloud computing, and artificial intelligence are all expanding at a healthy clip inside the country, and Alibaba's cloud division, still a smaller slice of total revenue today, happens to be one of its fastest growing segments by a wide margin quarter after quarter. The valuation gap here is honestly hard to ignore once you actually sit down and look at it directly. Alibaba trades at a forward PE of just 18.8 times against 66% expected earnings growth next year. Run that math yourself, and you land on a PEG ratio under 0.5, which is aggressively cheap for a company generating this much free cash flow every single quarter of the year. Analysts carry a strong buy rating on the stock with a $185 price target, implying nearly 50% upside from current levels. Is there real geopolitical risk baked into this entire story? Absolutely, and Tickerhawk isn't going to sit here and pretend otherwise for a second. But that risk is already priced in, arguably overpriced, at this point given where shares sit. And if China's economy even stabilizes modestly from here, this is a name that could move fast and catch a lot of people who wrote it off completely off guard. 3 buys down, 2 left to go. Now it's time to flip the entire script because the next 2 names are stocks. A lot of people are still actively bragging about owning right now, and Tickerhawk thinks that bragging is about to get a whole lot quieter over the coming months. First one, CrowdStrike, ticker CRWD. And let's be crystal clear about something before we even get to the numbers behind this call. This is not a company problem. This is purely and entirely a price problem. CrowdStrike is genuinely one of the best-run cybersecurity businesses on the entire planet right now, with recurring subscription revenue, a sticky platform. Customers almost never leave once they're on it, and a real competitive moat protecting the business from upstarts. None of that is in question, and Tickerhawk isn't disputing a single word of it. What's in question is what you're paying for that quality right now, today, at this exact price on the screen. Shares are up more than 90% year to date, and since bottoming at the end of February, they're up nearly 150% in a matter of months. That is an enormous move to happen in such a short window of time for any stock. Now look closely at the valuation attached to that move, a forward PE of 166 times earnings, an EV to EBITDA multiple of 114 times. For context, this company is expected to grow earnings around 30% next year. Paying 166 times for 30% growth simply doesn't pencil out under almost any realistic scenario you can build on paper. You'd need earnings growth to roughly triple from here, just to make that multiple even remotely defensible. This is the profit-taking call, not a sell everything immediately call, and that distinction genuinely matters to how you should act on it. Great company, expensive stock, and both of those things can absolutely be true at the exact same time. Investors love to argue this point like it's a contradiction, but it isn't. If you're sitting on a big unrealized gain here, Ticker Hawk isn't telling you to panic and dump the whole position overnight, just to seriously consider trimming some of it and locking that profit in, because chasing a stock at 166 times earnings purely out of greed has burned a lot of smart, experienced investors before you, and it will burn plenty more. And the last name on today's list, one that's been a genuine hero trade for a lot of portfolios this year, but might be running out of road, RTX, formerly. Raytheon Technologies, ticker RTX. Defense spending is strong, geopolitical tension isn't going anywhere anytime soon, and RTX remains one of the most important aerospace and defense companies in the entire world today. All of that is true, and none of it is really up for debate here. But here's the question, and Ticker Hawk wants you to actually sit with for a second before you get attached to this position. Has anything about this investment thesis meaningfully changed in the last 3 months? No, not really, if you're being honest with yourself. Everybody already knows global military stockpiles are low and defense budgets are elevated right now across the world. That's not new information hitting the market this week. That's old news the market priced in a long time ago, and arguably overpriced, and at this point, given the multiple, RTX is now trading near a 30 times earnings multiple, while only growing earnings less than 10% next year. Let that number actually sit with you for a second, because it's genuinely a little wild when you think about it. RTX is more expensive right now on a valuation basis than Nvidia, almost double in fact, and pricier than Alphabet too. Two companies with dramatically stronger growth profiles ahead of them over the next several years. When a slower growing industrial name trades richer than the single biggest AI chip company on the entire planet, something in that pricing is out of balance, and it usually doesn't stay that way forever once the market notices. Ticker Hawk would rather own either Nvidia or Alphabet at their current prices than own RTX at this one, full stop, no hesitation. Taking profits here doesn't mean giving up on the defense sector as a long-term theme forever. It just means this specific price right now, today, isn't compensating you for the risk you're taking on by holding it, and there will very likely be a better entry point somewhere down the road if you're willing to be patient and wait for it. Selling a great stock at a stretched price isn't betrayal, it's just discipline, and discipline is the part most investors skip. So here's your final scoreboard for today, laid out plainly. SoFi, Freeport-McMoRan, and Alibaba all get the green light from Ticker Hawk, real earnings growth trading at reasonable, or in some cases, outright cheap valuations relative to where the businesses are heading. CrowdStrike and RTX are both genuinely high-quality businesses that have simply outrun their own fundamentals for now, and that's exactly the kind of setup where disciplined investors quietly take some chips off the table instead of chasing the crowd higher out of fear of missing out. Here's a real question for the comments section below of these 5 names. Which one do you honestly think moves the most over the next 12 months, up or down, and why? Ticker Hawk reads every single answer down there, so don't be shy about it. And if this breakdown changed how you're looking at even one position in your own portfolio today, that's exactly what this channel exists for. So go ahead and send it to somebody else who needs to hear it too before they make a mistake. Next week's data is going to matter a lot more than most people currently think with fresh manufacturing and business activity numbers landing that could either confirm the slowdown story or put it to rest completely for now. That's going to shape exactly which stocks Ticker Hawk is watching next and where the next opportunity is likely to show up first. If you don't want to miss that breakdown when it drops, subscribe right now because the market doesn't wait around for anybody to catch up, and neither should your portfolio.